Okay, hello everybody. In this video, I want to give you a brief introduction to capital markets and what it means to go to the capital markets to issue stock or to issue bonds and some of the pros and cons of each of those decisions. So let me get me out of the way. So what you see here on the screen is like a diagram of um, on the left, I have a company, Needy Corporation, with a balance sheet. And let's say that Needy Corporation is needing some additional financing to grow their business. Now remember that the balance sheet summarizes a company's financial position. It's a statement of their accounting equation. On the left are the assets, a listing of the assets that the company owns, those things that are going to give them future benefit. And on the right-hand side of the balance sheet, it tells where the money came from to get those assets. So these two sides are always equal because it's the same money on both sides. The right side tells where the money came from, and the left side tells where we put that money, what assets we invested in. So on the right-hand side, the money that we get to finance our business can come from basically three places. We can borrow the money, which means we've got to pay it back. We can get it from stockholders directly out of their pocket. We call that paid in capital, and that represents what they have invested for stock in the company. And then, best of all, if we can be profitable, we may choose to keep that profit in the business. We call that retained earnings, and we're basically reinvesting those profits to grow the business. So the three places that we can get money to run our business is we can borrow it, which means we've got to pay it back. We can get dollars out of the owner's pocket that they invest directly into the business, paid in capital, and we can use profit that we have generated internally, and instead of paying it in dividends to the owners, we can keep it, we can retain it in the company and continue to grow that way. So let's talk about what these different options entail. First of all, if you may have made the decision not to borrow any money, but even if you've decided not to borrow any money, you can't help but have certain liabilities that just kind of pop up in day-to-day operations. For example, if you buy something from another company and they send you a bill, well, you now owe them something. We call that accounts payable. If you have employees, every day that they work for you, you are building up a liability to them, and then you pay that on payday. So if you're putting together a balance sheet between paydays, you're going to have some sort of a wages payable or salaries payable that you owe to your employees. And along with that, if you may have taxes that have been withheld or sales taxes that have been collected from customers, and these are amounts that you owe to the state or local government or federal. If a customer pays you in advance, like if you sell a gift card, well, you've already got the money, but you still owe them a product or a service. So we call that unearned revenue. So there's different examples of, we call these operating liabilities, operating accounts, different types of obligations that pop up just in day-to-day operations. Well, let's say that we want to borrow some or get some money either by borrowing it or getting people to invest in our company. So in that case, we are going to the capital markets. We're going to the market for money, the capital markets. So Needy Corporation, let's say, needs money. And well, fortunately, we got some folks over here that have money, and they're looking for a place to invest. Now, when you think about the folks that have money, immediately you might think of the Bill Gates and the Jeff Bezos and the Warren Buffetts, the rich tycoons. But most of that money in the capital markets, we're really talking about the accumulated dollars of all the rest of us. For example, some of us, you may put money in a savings account or in a checking account in the bank. And then that bank is going to make loans out, and they may loan money to needy corporation. Also, you and I we're paying, say, an insurance premium every month on our house or our car. Well, that insurance company, all those insurance companies, they have all these monies that they've been collecting, and they're looking for a place to invest it. So they may decide to loan money to needy corporation or buy stock in needy corporation, or they're going to invest someplace so that that money can grow and they can have a profit plus have the money that's needed whenever we make an insurance claim down the road. Or another big place is perhaps you're putting money into a 401k. And so that 401k, that retirement plan, is accumulating money from a lot of different individuals, and then they're looking for a place to invest. So we got all this money out here looking for a place to put it in order to earn a profit. Well, we got folks over here like Needy Corporation that need money. So how do we bring these parties together? Well, we call the middleman a financial intermediary. Common example would be just your local bank, commercial bank. They take deposits in the form of checking accounts and savings accounts, and they turn around and they loan money to Needy Corporation or some other company. So they give them the money, and Needy Corporation signs a promissory note, a promise to pay to that bank. So we just think of that as an IOU. Chances are, if you own a house, you have signed a promissory note to the bank. We call that a mortgage because it's collateralized by this property that you purchased. Or if you purchased a car, you might have signed a promissory note to the bank, a promise to pay that you're paying out over time. So that's one way that we might borrow money. Well, suppose Needy Corporation wants to get a lot more money than the local bank is willing to lend them. Well, what they might decide to do is go straight, instead of going through a bank, try to go straight to the capital markets out here and borrow money directly from them. And the middleman, the financial intermediary in that case, would be an investment bank. So the investment banker is bringing these parties together, the folks that need money together with the folks that have money. Well, if Needy Corporation decides to borrow money straight from the capital markets, they might issue bonds. Now, a bond, when you issue bonds, you're also issuing an IOU, but instead of issuing one IOU like you would to the bank, you're basically issuing a stack of IOUs. So for example, let's say you wanted to borrow $400,000. Well, every bond would typically have a face value of $1,000. So you really have a stack of 400 $1,000 bonds. And by breaking it up into pieces like that, now these folks over here that are looking to invest, one person might purchase 5,000 in bonds, and somebody else purchases 15,000, somebody else 20. So Needy Corporation gets all the money that they're after, but nobody has to invest, has to take, some huge amount of risk or any bigger of a risk than they choose to. So a bond issue is a borrowing transaction where these folks out here in the capital markets, they purchase the bonds. Needy Corporation is selling the bonds, but even though we're using that terminology of selling and buying, what it is a borrowing transaction. So the investors are giving money to the company, and the company is given an IOU, a bond, to the investor. On the other hand, it could be that a needy corporation has decided to issue stock. If they issue stock, then these investors are not loaning money, but they're actually purchasing a piece of the company. They're purchasing a share of stock, and they now own a piece of the company. How much do they own? Well, it depends on how many shares there are. If there's just one share of stock and you own it, you own 100% of the company. If there's two shares and you own one of them, you own 50% of the company. But if there's 1,000,000 shares and you own one of them, then you own just a very small piece of the company, one millionth. So what do you own? Well, let's talk about the rights of bondholders and stockholders. If you purchase a bond, you are loaning money to the company, and what you get in return is a contract where they promise to pay you back with interest. So it's a lending contract, and you're given the right and the expectation of getting that money back with interest. On the other hand, if you purchase a share of stock, you're getting no guarantees. You're not guaranteed the price will ever go up. You're not guaranteed that you'll ever get a dividend. Remember, a dividend is a distribution of profit, and if there's no guarantee, the company will be profitable. And if there's no profit, there's nothing to pay in a dividend. So a stockholder doesn't have any guarantees, but they do have some rights. One is they have the right to vote. And the main thing they vote on is who's going to run the business. They're going to vote on the board of directors. And then the board of directors will appoint, say, a CEO and a president to kind of run the day-to-day affairs. But as a stockholder, you get one vote for every share of stock that you have. If you, let's say somebody started a company and then decided to issue stock, but as long as they keep 50%, over 50% of the stock, every time they get together to vote, they win because they have more than 50% of the votes. Another right you have is the right, what's called the preemptive right, which means you have the right to maintain your ownership percentage. So let's say, back to that example, that you own a little more than 50% of the stock. Well, if the company issues more stock, you have the right to you have first dibs on your 51% of the new stock in order to maintain your ownership percentage. That way they can't sneak over here and issue more stock and just eat into your percentage of ownership. So you have the right to vote, the preemptive right. You have the right to participate in dividends if they're paid. They're not guaranteed, but if they do pay dividend, you get your share. And finally, if the company goes out of business, you have the right to participate in the leftovers. If the company liquidated, what they would do is sell off all their assets, pay off their liabilities, and if anything is left over, it would be divided among the stockholders. So you have that right into that residual benefit. So, putting all that together, let's say a company is trying to decide if they want to borrow money or issue stock. Well, they're going to go to the investment banker and someone who's an expert in finances and get some help in making that decision. But at the core, if they issue stock, the nice thing is they're not giving up ownership. So the existing ownership is not watered down, it's not diluted. And the interest on the debt is an expense that lowers your income, and therefore it lowers your income taxes. The bad thing is you got to pay the money back. You got to pay the principal that you borrowed, and plus you got to pay the interest that you've promised in that contract. If you issue equity, the nice thing is you never have to pay the money back. You're not making any guarantees. You're not guaranteeing they'll ever get the money back that they've invested. You're not guaranteeing any type of dividend because you're not guaranteeing any profits. However, if you don't provide a return to these stockholders, remember, they're the ones that own the business. They're the ones that vote on who's going to run the business. So if the existing management does not do a good job, then the stockholders will vote them out and vote somebody else in who can do a better job. The bad thing about issuing stock is now the ownership is spread out over more shares. So we would say it dilutes ownership. If you pay a dividend, you got to divide that dividend out over more shares, so it dilutes, how much each one is getting. The value of each share, we now have the value of the company divided over more shares. So again, that dilutes the value of each share. And the other disadvantage is when we pay dividends, it's not considered an expense. A dividend does not lower your profit. It just lowers how much of the profit you're keeping. It lowers your retained earnings, but it's not a tax deductible expense. So when a company goes to the capital markets, the big decision is, are we going to borrow the money or are we going to issue stock and let these folks own a piece of the pie? And so when making that decision, you want to understand the pros and cons, the advantages and disadvantages of each.